is Monday, Weekly Jump, and it is August 17th. Figure that. Now, August is the month of risks, right? We were going to take a look at a bunch of different risks. Obviously, for those that are on Zoom, we're actually going to pre-record this week. We're kind of doing this a couple of hours early. I got to personally jump to take care of some home front stuff. Steve's obviously on vacation again. Man, that's awesome, right?
I'm jealous.
We haven't taken a vacation, have we? Oh yeah, I did two weeks ago. So, anyways, yeah, August is about risks. So we're taking a look at various risks. Last week we touched on the people risk. Prior to that, I know you and Steve
general risks, AOP, plan, finance.
Right. And risks kind of flow nicely into that because you plan but you're planning for both upside and downside. You're planning for things that maybe are unforeseen. So it's part of the planning process. You know, you put your annual operating plan together, and inherently in that plan, there are risks. It's a plan. And so our job is to help small business owners identify those risks and then ultimately do what with those risks? Inventory them,
countermeasures,
create those countermeasures, right?
Put all the thoughts that people have in their heads, because a lot of the risks that we talk about, like people already know them, right? It's nothing new, right? Some of them are, but a lot of times it's not new. It's just getting out of their head, getting on paper, and developing a plan as to what you're going to do after the fact.
Right. And if you go back to like Finance 101, risks are, you do a few things with risks. You deal with it. You just kind of accept it and you not manage through it, but you just accept it. One, you transfer it. Two, you mitigate it. Or three, you ultimately eliminate it through some other countermeasures. So not to kind of get into the weeds of finance, but what we want to talk about today is looking at working capital risks. This is actually a great time, unfortunately, but cash is tight. There's been a lot of lending, as we know, public finance, but ultimately that stuff dries up, and business owners need to start acting like business owners again and being good fiduciaries and stewards of their capital. So we talked a lot about like surviving and thriving, and this kind of goes back to that series of like, okay, once you get past this, how do you ensure that you've built a foundation, your thought process, your planning process.
And I also think that leading up to this point, I think this is a good timing, because leading up to this point, it was managing the risk of people, right? You had the PPP. You're able to kind of get along without really having to think about your working capital too much, for better or for worse, because of the stimulus programs that were out there. So now that these are drying up, as you mentioned, now's the time to think about it.
So the first slide is kind of August is risk month, identifying those risks, understanding your risks, and then managing your risks. But more importantly is taking inventorying those risks, like we talked about, and developing countermeasures to make people responsible and accountable, so that hopefully maybe full circle you're paying for that performance, right? Different types of risks, cash, people, economic, and of course today political is a huge one. Election year, social risks, asset value risks. I mean, we don't have to look that far. You look at the stock market and we're at all-time highs in the middle of a pandemic. Although not always a good trade when you're trading against the Fed. So when the Fed's pumping money, Trump pump, right? You probably don't want to bet against it. But with all that said, I would be hedging right now. We'll talk about asset valuations in the coming weeks, but let's talk a little bit about working capital risks. So that's our focus for today, and what you can do today to begin thinking about and improving your working capital situation. So let's talk about some of the things that are inside as a working capital risk.
I think one of the first things that we always look at, I think regardless of customer, regardless of entity, business, revenue model, et cetera, we always find ourselves going to AR, cash, AR, AP, I guess just as like a high level.
Yeah. Which is a good starting place. I mean, that's kind of the basics. I go to what is a cash conversion cycle, right? That's a great way. When you start following the breadcrumbs, right, from cash.
Yeah.
How cash starts, right? Whether it's placing that first order for inventory, paying your employees, right, and then ultimately paying your vendors, and then cash tied up on the shelf, right? All of that stuff, and then ultimately culminating in cash collections.
No, I think that's a good point, because you're right. ARAP may be a afterthought, but I find myself going to that often. But a lot of people don't really think of what that cash conversion cycle is, right? Theoretically, you think of it and you know it. I have to produce the widget before I can sell the widget, right? But to produce that widget or produce that product or service, even, what is the goods or resources that you need leading up to that? Maybe it's 45 days out, and then but between the time that you can produce it and sell it, it's another 30 days. By the time you collect the money, it's another 30 days.
Yeah, totally. I mean, you think about these retailers where, say, 25% of the annual revenue is generated in that last week or last 2 weeks of the year.
Yeah.
Who's really going to put their neck on the line right now and order a ton of inventory in preparation for the holiday season? Kind of a scary time when you're thinking about working capital.
Especially in a time like this.
Especially right now, right? So here's some of the components of working capital. This is not all, this is not like an exhaustive list, but this is a good low-hanging fruit. It's the cash planning and revenue model, right? I know revenue model and cash planning is not really considered working capital, but I go to that because that begins, because there are two ways to look at working capital: tactically, which I'm a big fan of, the blocking and tackling of calling customers for collections, the blocking and tackling of, pencil to paper. What happened? What's the situation? What's my expectation? What's my probability of collections? Because then that's important. But by the same token, like I would look back at our business 5 years ago when we were 100%, our revenue was 100% based on time and materials, to today where we're closer to like 85% monthly recurring revenue with very limited amount of time and materials, more of a special situation. So that whole situation, that allowed us, because as we started thinking about like our days outstanding, how many days does it take to collect cash from your customers? Well, our days outstanding used to be like 60. And of course, some customers kind of put the screws to you and they would like prolong that 90 an entire year sometimes. It's not worth it. I'm not a bank, right? I always tell our customers, you're not a bank. So don't be financing your customers. You use terms to secure a transaction, right? You use terms to secure revenue, but you're not a bank. So don't lead with terms. Lead with your value prop.
So if you're a small business and you've never done this before, gone down that, like, what is my days outstanding, right? How does a small business that's never done that exercise, how do we even approach something like that?
So, I mean, there's a million ways. So we had Brian from the Tally Street here probably 3 months ago. We talked a lot about days outstanding, operational versus financial metrics. I'm still a big fan of, what's my average, what's my revenue, what's my AR, you normalize that, you average it, and that's kind of your days outstanding. Essentially, how long does it take? How many days does it take for you to collect that dollar you invoiced today? Well, I'm expecting it to take 45 days or 60 days. Great, now you can begin to plan. But we're going to touch a little bit about like the tactical and the strategic part of working capital risk. So accounts receivable and collections we talked about. Inventory management, prepaid expenses are always a place where you realize, oh, I have cash tied up on my balance sheet because I decided to drop $10,000 on workers' comp insurance, right? Obviously, there's a cost to all of this, right? Because if you are on a payment plan with insurance companies, they tend to upcharge you, but or give you a discount if you pay up front. And then, of course, lastly, accounts payable and vendor management. I would even throw something like deferred revenue into this, because deferred revenue is not working capital, but it ultimately becomes a driver of negative implications.
You have to plan for it.
You have to plan for it. But deferred revenue is also a great way to boost your working capital up front, right? It's a great drug for your balance sheet.
As long as you can plan.
Yep. So tactical execution is key to managing working capital risk, and more importantly, know your cash conversion cycle. So let's take a look at some of the questions and some of the questions that customers do ask, and what are the underlying risks, and what are some of the things. Some are really, small, tactile efforts that you can do, and others are more strategic, right? Like changing your entire revenue model to improve your days outstanding. That's like oil and water. So, question number one.
How do I create visibility into my cash planning?
Yep.
The risk specifically being uncertainty around what that cash conversion cycle is, what we just talked about, right? And how do you deal with that? What's your countermeasure against that?
Yeah. So this is based on customers market always asking, how do I plan for cash? Cash is so volatile. It's so hard to tell when I'm going to collect. I don't know how much inventory I'm going to need right there.
Sure.
Yes, there's a level of planning that's just like you can never have 100%, right? 100% bulletproof planning. There's always going to be these risks, but it's knowing these risks is what's critical. So I would say, start by identifying the components of your working capital. Every business, there's going to be idiosyncrasies to your business, whether you're a service-based business, a restaurant, everybody's going to look a little bit different. Understand, and don't go after all 100%, should focus on the 80%, right? What are those components of your working capital that truly do drive your working capital needs? There are a lot of customers that, for example, they receive a vendor bill, and instead of allowing those bills to pile up on your desk and maybe batch them into once a month payments, twice a month payments, once a week, they're paying these bills as it comes, right? That's a poor cash management. Now, when you're cash rich, which many businesses have been pretty cash rich over the last 10 years, banks have been lending. 6 months kind of shows you differently, where now you need to start managing your cash a little tighter. So start with identifying what are those unique components to your working capital, to your cash conversion cycle, and then begin to target those. So we're going to try doing a few of these, because the next question is,
why is my AR flat, yet revenue has decreased? AKA, why is my AR not proportional to my revenue? In other words, the risk is basically revenue versus cash, right? Right,
it's revenue versus cash. And in times like this, you don't want to shut your doors. So you tend to maybe provide better terms. Well, not those terms aren't better for you, the company, but for your customers.
To keep the revenue.
Yeah, to keep the revenue. And maybe you're stretching on revenue. Maybe you're even still servicing or selling to customers that may not actually survive this in the next 6 months. And so what's happening is your AR is getting stretched, and you're making decisions that could inherently add more risk to your business. So revisit your revenue model. I think, yes, there are two parts to the countermeasure here. One is much more strategic. Revisiting your revenue model, right? Is there a way to get cash earlier, maybe through prepayments or cash payment discounts, right?
Require upfront payments at 50% through this because of this stuff.
Right. In times like this, I would rather take it in the chin on my gross margin, but making sure I've got the cash in the bank. So it's this is a great sort of period, and I think your own customers will appreciate it and maybe will take advantage of it. It's that early payment discount. So, and the more tactical one, which I'm a big fan of, which we do a lot of times here, is risk rate your customers like today. We just went through this exercise last week with another customer and said, okay, here are your 50 customers. You don't have to go through the whole 50, right? Go through like top 25 that account for 80% of your revenue, which probably accounts for like 80% of your risk too. Identify those customers and risk rate them. Like, what is the economic impact going to have on this customer? And what's, how important?
So I feel like you should almost do that to some degree, even mentally, through this, right? Your point was, you know, maybe you have to revisit your revenue model, or maybe you have to revisit terms with customers because you need 50% down, right? Well, maybe that's only for a select few customers because of the profile of them.
Yeah,
right?
totally. Because one of the last questions here is about vendors squeezing you, but we'll get to that one at the last one. So the next question is still around AR is?
It's so if a customer is taking longer to pay the bills, how can I improve collections?
Well, you know, that's always harder, right? So the risk here, of course, is, you know, the economic impact that, you know, this is having on your customers. So here's where you got to be super tactical. I'm not saying you spend an hour every day doing this, but or for some companies, you should probably already have a dedicated person. This is really where the biggest risk is going to be on many larger customers, and not having your eye on the ball, or passing the buck to some junior analyst or some junior accountant to really manage such a critical risk, you know, that in your business. So being tactical, now more than ever, actively managing the AR, your accounts receivable, and also more importantly, managing and having proactive conversations with your customers so that it is ultimately feeding into your risk, your customer segmentation and risk profiling of those customers. Getting a better sense. Now, I mean, we should always be calling our customers up and, you know, see how they do and feedback. You can do that now, but with an eye towards risk, right? With an eye towards, is this going to be collectible?
I think you made a good point too. On top of that, semi-related is, you know, you said, don't let a junior accountant or junior analyst kind of just go and run with this, right? One of the things that we kind of don't really touch often is the invoicing, right? The flip side of this. We don't really touch invoicing for many customers because of the fact that it's the last touch point, right? This may not be the last touch point, but this is a critical touch point with those customers. And
I wouldn't want to transfer the risk of my invoicing or collections. You know, and you know, the irony here, of course, is we do get inquiries from the market through our marketing efforts, like, hey, but can you guys, you know, oh, one of the worst things I hate doing is invoicing. Oh, and collections. Oh, that's like a grind. Can you do that for me? It's like, yeah, of course we can do it, but no, we're not going to, right? And if that's a game stopper, that's fine with us. We'll move on. Not a big fan of outsourcing collections, not a big fan of outsourcing invoicing. I am a big fan of course, automating invoicing, and I'm a bigger fan of rethinking your revenue model to drive cash. But not every company can do that. I totally get it. And so now to our next question, that's going to be more focused around inventory, right?
And so how do I calculate inventory turns?
Yeah, great question, right? I love that question because it really shows the fundamental movements of cash. And there's nothing more important in cash, unless you come from a finance background. One of the most important fundamental factors of measuring cash performance is the velocity of cash. How many times can I turn that cash? How fast is your cash turning, right? If my AR has 30 days outstanding, it essentially means I'm turning cash 12 times a year. My AR is turning 12 times a year. You can pretty much, like, you know, guesstimate that $1 million company turns cash 12 times a year. You got about $80,000 to $100,000 in cash invested in working capital that's sort of just waiting to be collected. Cash turns is inventory turns is the same thing. It really goes to show how efficient you are with your inventory. So another example has been, especially in retail, you walk into some mom and pop shops and you must have, like, I don't know, like a freaking 1,000 SKUs, right? And the store is just packed, right? But it is part of that store, that retailer's value proposition and their branding, that they've got everything under the sun. Unfortunately, I know what you find is that, you know, only 20% of that inventory actually contributes to 80% of the revenue, one. And two, what you find out is the inventory that actually does contribute the most to revenue is the inventory that probably costs less cash to have invested sitting on, you know, on a shelf. And the rest of that inventory, or that garbage, is just garbage, right? It's just sitting there, and it's the value is depleting every day.
The value is almost psychological for the customers.
Right. And so managing inventory by starting with, you know, knowing what are your top sellers, right? Take all the SKUs you have and figure, and by the way, it doesn't have to be just a retailer. This could apply for manufacturing too.
Sure.
It's just a little more complicated because you've got different components that are
A lot more
integrated,
SKUs.
a lot more SKUs, a lot of unfinished goods. But managing your inventory by starting with knowing what are your top sellers. Of the 100 items I sell, my top are these 20.
Knowing where you
Great.
can lose money.
And we'll go back to that. And it's knowing where your cash flow is too, because the other 80% of your inventory is just cash that's stuck there.
Mhm.
It's just another medium of value.
Mhm.
Unfortunately, you can't really trade that stuff. And so think of maybe think about blowout sales, right, to reduce the working capital risk. So if you are finding that you do have inventory that turns once a year or maybe once every 2 years, think about blowing that inventory out and not selling that inventory on demand, but maybe ordering it on demand, right?
Yeah, I also go like this is probably an exercise that should not just be done now in a sense of like measuring cash and thinking about cash conversions, but like this exercise in going through top sellers and things like that and understanding your actual inventory and how it sells is a great exercise that should be done.
Yeah.
I would maybe not monthly, but quarterly, right? So,
totally. I think you need to know who are your best performers. And what I love about this conversation around inventory is we just had a customer. Well, they're going to be a customer. They're in the sort of small business fulfillment world now, where you don't need 100 SKUs in your shop.
Yeah.
You just need the 20 SKUs that move, and then maybe you have the other 80 SKUs, or a customer comes in and maybe you can't walk out with it right away, but you can order it,
Yeah.
right? And it will show up at your doorstep in 2 days. I think that's rethinking the whole inventory management. And so how do you calculate inventory turns? Trick question.
Oh, how do you lost me there for a second.
Okay, Steve. How do you calculate
How
inventory
do you
turns?
calculate inventory turns? Great question.
MBA question.
MBA question. So it's really knowing how much you have in inventory, how much you're selling, and going back down that list. And so you probably want to pull a data, whatever your POS system is, and understanding going down whether it's by SKU, whether it's by category, whether it's by however you want to slice and dice that, and really measuring, the time in which you got it in stock and how many days, kind of like your DSO in a way, how many days out since you actually sold that, and whether that's, slice and dice by category, SKU, shirts, pants, etc.
Cool. Another easy way to do it is take how much inventory you have on average on a monthly basis and divide it into your annual cost of goods sold, right? So if my cost of goods sold is, call it $1 million, $1 million bucks, and I've got $100,000 in inventory on average, you're turning your inventory, you're doing actually a pretty good job if that's so the key here is to maximize your inventory turns, because that means for every dollar that you have on the shelf, it is being recycled back to velocity, right? I love that, cash and velocity. So last question here is,
Tie it back all together.
what happens when the vendors put the screws together?
So if the vendors start squeezing working capital, so the question, my critical vendors have changed my terms from net 30 to COD.
Yeah.
Something that we've been seeing
A lot.
a lot lately.
Yeah, you're pretty much screwed. That's not a very fun situation to be in.
And I think it comes down to, once again, like knowing, going back to, the last conversation we had about this was about customers, but with vendors too, understanding who the vendor is, right? Because maybe the option is there's another vendor that does something, provides the same product, service, et cetera, right? That maybe changes this, that eases the burden there. But if that's the only vendor that you have, some of the conversations that we've had is, maybe working out a plan on prepayments. Right?
Pick up the phone, communicate. All your stakeholders.
Yep.
You should be calling up your bankers, you should be calling up your customers, and you should be calling up your key vendors and communicating openly with employees. We've been preaching that for a long time. Vendors are a key stakeholder, right? You cannot make widgets unless you have a supplier. So negotiate and do everything possible to stay current, right? If if you are showing signs of weakness, don't be surprised. Your vendors are going to pull back.
Yep. Just as you probably are
just
going
like
to.
you would, right? Let's face it, when you're starting to see cracks in the foundation, the first thing you do is you step back and you poke around, you try to figure out what's happening there. So negotiate, it never hurts. It is a tough bullet to that's a tough tough pill to swallow, if you will, going from net 30 to COD. It does happen. So staying current, maybe asking for early payment discount. So in exchange, sure, I'm willing to go COD, even though I know I don't have a choice to do what my vendor is asking, but maybe there's an opportunity to get some pricing
Elasticity.
or yeah.
And then kind of tying this back to the last slide, what if that vendor term changed from net 30 to COD, how does that now change that whole cash flow cycle, right? From ordering to cash in the door, right?
Totally.
How does that change it?
How does it change your overall plan too?
Yeah.
So, and the nice thing about working capital is you can almost tie each component of the things we just talked about to different people in your organization and making them responsible for optimizing or minimizing the risk, managing through the risk, and making them essentially accountable. I've seen pay for performance plans that actually tie in working capital, not just revenue growth, expense management, but also working capital management and managing to a certain amount of working capital invested in the business. Remember, working capital is dollars that owners take out of their pocket to fund the business. It's real money. So anything you can do to manage through that is important, especially in times like today where you're going to see a lot more companies being cash poor and revenue rich, right?
So what are some of the things, kind of just in closing, like how do we work with companies on this whole working capital? I mean, that's a big conversation, right? But
huge conversation.
Talking a little bit about what we just went through, kind of some of the topics, some of the things that we've been seeing in the market in terms of where companies are really struggling. How have we helped them through this?
So I go to the components of working capital, like literally what we just walked through. I'll walk into a customer, let's say for simplicity, $12 million a year manufacturer. Then I start poking around and I realize, oh, you've got on average about $1 million in accounts payable. Okay, that's not too bad. And then you have about $4 million in accounts receivable. Okay, that's not that good, right? Because right off the bat, not including anything else, 4 million minus 1 million, that's 3 million. 3 million into 12 million, you're essentially, that's 4 times. That's not good, guys.
Yep.
Like, that's not a good use. And to boot, it's like you also have a lot of risk. You have a lot of credit risk exposure, possibly. I mean, you have to get into the customer and the industry. But right off the bat, if I see a customer like that, I said, okay, here's the problem statement. Now let's break this down and identify what are the drivers that we can, we can pull, or how can we rethink the drivers? So an example like where you have $4 million of AR exposure on a $12 million a year company, that's not a good situation because that kind of puts your days outstanding like north of 120, right? Because you have about on average 4 months outstanding. That's brutal.
Yep.
That's brutal. So I'd be looking, so for a company like that, tactically and strategically. Strategically, well, that's easy, right? Let's talk about the revenue model, your customer profile, how you're servicing, policies, procedures, systems. Are you invoicing once a month? I mean, if you're invoicing once a month on the 15th or the 30th of the following month for the prior month, right there off the bat, you've lost that entire, you could be servicing a customer on the 1st, on the 1st of June and waiting almost until July 31st to invoice for that value that was generated, 60 days ago. That's brutal.
You might have more cash in your pocket by spending the extra time to invoice more frequently.
Right, but what happens is your operating expenses go up, because in order to invoice weekly or invoice
You
every
need
other
more
week,
resources.
you need more resources. So your expenses may go up, but what people don't realize is, again, we're still in a low interest rate environment.
Yeah.
The problem is access to capital has dried up.
Yeah.
I mean, you put aside PPP monies and government monies and grants, the banks aren't lending, guys. I mean, folks, when's the last time I had like 3 conversations with big banks last week, and they all said, yeah, we're holding on to it. Like, we're here to stand by our customers, but we're not sure we're in a position to want to lend to new customers. So with that backdrop, you know, and knowing that interest rates will have to pop at some point, you know, now is the time to start rethinking this. So with all that said, that's this week's jump. Hope Steve's enjoying his camping trip.
Hope he watched us.
Do you have any vacation plans in the next week or 2 month? No, nothing. I'm probably gonna spend another week somewhere, but yeah, it'll be a drive,
Not far.
stay vacation.
Not Portugal this summer.
Cool, guys.
All right.
Appreciate it.
Thanks everyone.
Nice jump.